Well, joining us now for more on what's moving the markets is Brian Bethune. He's the chief financial economist at IHS Global Insight. Brian, welcome to Bloomberg News. Always good to see you.
Yes, great to be on your show this afternoon.
Brian, thank you so much. As Julie just mentioned, that G20 news that we were hearing about the roadmap that they're taking to try to prop up the economy. I was wondering if we could start there and get your thoughts on what's going on there.
Well, clearly here, the G20 wants to keep, a strong forward thrust on their policy, especially monetary policy, but also to the extent that they can on fiscal policy. I think the indication is that even if you look at the signs of recovery that we're seeing, there still is not really an underlying strength. And on top of it, the banking system in both Europe and the U.S. is still under a lot of stress. So at this point, they're indicating they want to keep policy in a very stimulus type of mode.
Right. Well, Brian, you mentioned the banking system. Are banks still making the most of their profits in the wholesale market?
Yes, they are. They're still, most of their profits are in their in the wholesale trading activities, mainly the money center banks that are benefiting from strong growth in bond markets, equity markets, foreign exchange. So that's where the bulk of their profits are coming from. But the loan loss reserves continue to rise. So they have this issue that they have to keep profit growth up in order to absorb the loan losses. And that's an issue that is restraining credit growth right now.
Brian, speaking of credit growth and speaking of loan losses, I just wanted to reiterate some headlines that just came out from the Federal Reserve Senior Loan Officer Survey that they do quarterly. Fewer banks tightening lending standards, they said, for companies and consumers in the third quarter. Also saying that a demand for most types of loans weakening, but weakening at a smaller number of banks than in the second quarter. So credit is getting a little easier, Brian. Even though you are seeing, of course, a lot of folks out of work right now, why aren't more people sort of going to the well in terms of trying to get loans now, if indeed the standards are getting a little bit looser?
Well, it's a combination of a number of factors. There was a period of time when credit conditions were extremely tight, in fact, at historical highs. So the banks made it difficult for a long period of time for people to get credit. And that's what we've seen now in declining credit aggregates. Both consumer aggregates and business aggregates have been coming down. So now we're in a situation where the banks are a little bit better positioned to be able to lend, but there's been such a shock to the household sector in terms of their net worth and the unemployment rate going up, that there's a reluctance to borrow at this point.
And do you think that's going to continue until employment starts to come back? Even if credit does get easier, that people are not going to be looking for it because they're still perhaps out of work?
I think that that's correct, that the demand for credit is going to stay fairly, at low rates of growth, although I think it will be helpful if the banks were more prepared to lend, because there are credit-worthy borrowers that are having difficulty getting credit. So at least it would be nice to see the credit aggregates stabilize and not continue to decline.
But at the same time, do you think it's healthier for the U.S. economy that you don't have the same sort of borrowing rates right now, and you might not for the near future?
Well, there is this issue where we're seeing the balance sheet of mainly the household sector being restructured, in the sense that debt is being reduced, but a lot of that was precipitated by severe declines in asset prices, both house prices and stock prices. Well, now that we're seeing house prices go up, we're seeing stock prices go up, so household wealth has improved. So that provides a better basis for households to be able to borrow now. So I think there is a potential now for households to borrow, and the banks, if they do ease their credit conditions, then we could get much healthier conditions in the credit markets. It would be great if we could see some expansion of some of these credit aggregates.
Brian, might I ask, we see central banks around the world holding short-term rates near zero. Some are even starting to unwind emergency measures. Any concerns that a premature exit strategy might slam the brakes on a recovery?
Well, I don't see signs that there's any tendency for them to go and try to execute an exit strategy that would be too far in advance of what would be desirable. I see very little evidence of that happening, and that was part of the positive news that came out of the G20 summit, is that they will continue with the current very accommodative policy stance, and any exit strategy would be postponed probably until the fall of 2010, when we have more strength generally in terms of the recovery. So I don't see that being a risk right now. I don't see that there's going to be any premature moves that would potentially upset the recovery. I think they're aware of the risks that are out there. They know what's happening in the banking system. The banks are still undercapitalized.
Right.
And there is a deficiency in terms of the projected, we talked about the credit aggregates, but if you look at the banking system capital and the pressure on it, and you project out, there's insufficient credit supply from the banks to meet predicted demand. So even the quantitative programs, which provide credit to the economy,
right,
are a very good stopgap measure,
yeah,
to get us through the early phases
Brian,
of recovery.
Just real quickly here, though, what about the risk of the dollar remaining as low as it has been and the effect that that could have on the U.S. economy? And again, just quickly here, about 30 seconds.
Well, actually, I don't think that's a big issue. I think that the declining U.S. dollar is very positive, as we've seen for major companies like GE and Caterpillar that are exporters, and we are looking for exports to lead us out of this recovery. So, at this point, a lower U.S. dollar is actually desirable in terms of energizing the recovery of the U.S. economy.
Brian Bethune of IHS joining us from Lexington, Massachusetts. Brian, as always, thanks so much.